Morning Money on Share Radio.
Well, investor sentiment towards real estate remains positive globally. That's according to Colliers International's Global Investment Outlook Survey, which points to transactional activity. Over the first 9 months of 2015, direct property investment reached $625 billion globally. That's an 11% increase on last year. It's also reflected in investor desire to increase allocations to the sector. Well, Bruno Berretta joins us now. He is EMEA Senior Research Analyst at Colliers, talking on real estate returns set to see some long-term stability. But you've got to remind us what EMEA stands for, Mark, before we talk to Bruno.
Well, of course, that's Europe, Middle East and Africa areas. Good morning, Bruno. Thanks for joining us this morning. Sorry, John, but I had a look at your executive summary of your report, and one of the things that struck me that was really interesting was that you said the days of pass the parcel are over. Long-term secure investment in core markets will be the norm. What does that mean?
That means that probably in the core markets or Western Europe, we're going to see probably a bit less of short-term trading because prices have reached a point where when you start with investor will come in looking for long-term security, long-term investment. So we're going to see more of this type of investment. So more long-term investment as opposed to short-term trading, to investors moving in just to buy a property and resell it, quickly. So, and I think it's a positive news overall for the markets. We expect to continue different type of capital to move in and to generate volumes, and this is true for all the key Western European markets for sure.
So, which geographical areas are investors most keen on?
Well, it depends on your strategy, of course, and on the type of the returns you're targeting. But what the survey tells us is that a lot of investors, particularly global cross-border investors, still value and appreciate the liquidity and the transparency of key European markets. And those markets particularly offer larger lot sizes, so big, chunky buildings, and investors are able to deploy larger sums all at once, and that is definitely a plus.
But this is a trend, isn't it? The large solid building with perhaps lots of residents or lots of companies. So you've got a guaranteed sort of market of income and stuff like this.
Yeah, we got particularly pension funds or institutional capital. They have large amounts of money, and they just need to place them, and these types of property really offers that. But then if you're looking for an extra returns, you may want to actually venture deeper into outside the whole of Europe. So I'm talking about some Southern European markets.
Like where, for instance?
So for example, Spain has seen a boom investment last year. This year has been really good as well. Some analysts think Italy will be next year. So
well, these are what we call peripheral countries in the Eurozone, aren't they? These are the countries that were really badly hit by the financial crisis, and property markets have been appalling there for years. I mean, Spain's property market fell really badly, didn't it?
Yeah, they're really badly, especially the residential market. They saw a massive correction, but now the economy is growing quite fast. It's picking up pace, so that has attracted investor attention, and we've seen a lot of investment, foreign investment as well coming in. So that's the good news for those markets.
I'm thinking about the countries that have young populations, such as Poland and Romania. There's the youth there. I wonder if there are if that features at all in your survey. Poland in particular, I'm interested in.
Yeah, Poland in C, I think can be considered one of the most liquid and attractive markets, and I think it still ranks quite high in investor shopping list as far as that part of Europe is concerned. Particularly the logistics sector attracts a lot of capital there, and it's got young population. So demography is very important, and particularly long-term investors really have in mind the mega trends when they're investing, they put their money, and population growth is the key criteria.
Well, it's interesting because one of the things you state in this latest outlook is that the capital is mainly local, but globalization continues. I'm really interested to know what that means, because we often complain here in London that international investors are buying up huge swathes of London, and no one's living in the properties, and everyone's investing in London property and realty. No one's living here. So how is that different in other parts of Europe or other markets?
Well, you have to say that London in Europe is the typically regarded as a getaway, to foreign capital. So when a new investor enters Europe, usually it's via London. So London, really benefits from these flows from overseas investors. Other European markets do also benefit, but to a lesser degree, probably I would say. And we expect this foreign money to continue, keep on coming, and we got new capital sources from Asia and US. Pension funds. So there is really a very diverse mix of investors choosing properties and returns.
So you're talking a lot about the positives, but what are the key risks to this asset type according to your research?
Well, we asked that question to investors in the survey, and some of the key risks that were mentioned were, for example, the economic slowdown in China, the rise of interest rates, the length of the cycle. My opinion actually that is in Europe this is a lower risk environment compared to a few years ago. So interest rates aren't going anywhere. They will stay low for longer in Europe. In the UK, they will increase sooner, but I think the Bank of England communication around interest rate increase has been clear. So increase will be gradual and very limited. I think probably there's an element of political risk in Europe to some extent, because of the rise of more extremist parties. As far as the UK, some investors told us about Brexit, but they're not majorly concerned about it. They think it's gonna generate a bit of volatility in the run-up to the vote, but they don't think it's going to be a massive problem, and they think the UK will continue to attract investment, actually.
So it's interesting because that's UK and Europe. But if you look towards the Americas, which you also cover in your report quite nicely, I mean, some of the targets, some of the key cities are quite interesting. So you have all the usuals like New York and LA, but you also have like places like Denver, Philadelphia, Austin, Rio, in Mexico City, in Canada, Montreal, Ottawa, down in South America, you have Sao Paulo, Mexico City, Rio de Janeiro. I mean, these are all places that are also feeling the effects of the slowdown in the global economy as well. And is that precisely why the investment's going into property? Because it's seen as more safe in a riskier environment, even in those places?
I would say that the fact that more money is coming to property is also part of a diversification attempt. Global investors, looking to diversify their holdings away from other asset classes like bonds or equities, and some pension funds, for example, they have target allocation to real estate, and for some of them they're actually lower, so they're actually catching up. And I think the spread of property yields versus yields for other asset classes is still very attractive.
So we started off this interview talking about the 11% increase on last year, the fact that the first 9 months of 2015, direct property investment was $625 billion US. But do you see similar growth in 2016, or do you think there's going to be the caution and a greater gentility in this type of investment?
For 2016, we still expect a very strong year. I think all the conditions are in place. I don't know if the volumes will be reach the same level in 2015, but I think we really expect capital to continue to flow into the sector. So still very healthy market condition and a lot of interest.
Well, we were talking earlier, Sarah and I, about the global mergers and acquisitions market being driven by the fact that investors want yield and they want growth and they want a good return on their investment. So because there hasn't been any growth in much of the world, because of the slowdown that we're seeing, the things you're talking about, and all the economic and geopolitical factors, so people are forcing companies to go look out for mergers and acquisitions as a way of saving money and getting some growth, so better shareholder return. Is it a similar thing that's driving investors into more and more property? Because as you say diversification on one hand, say from bonds, but there's no yield in bonds. There's no money to be made in the bond markets. If you look at the stock markets this year, well, we're not anywhere near where we started. So the markets have all fallen. So are you just a beneficiary? Is the property sector just a beneficiary of people throwing more money into property?
Yeah, definitely. And I think, if you take, for example, 10-year bond on 10-year German government bonds, they're around 0.5%.
Yeah.
And in the UK, they're slightly higher, I think around 1.8%. And for example, prime office properties in tier 1 cities in Europe trade at 4%. And that is the low end of the spectrum. So there is, still, juicy gap actually there. So and that's why, that's drawing in more money.
I want to know about what Colliers does. Tell me a bit about your company, about your specialities, and who reads your research, and whether you're influential at all in the markets.
Well, at Colliers, I work in the research and forecasting team in London, and I'm responsible for European markets. And basically, I work with a lot of different people, internally, externally. So we help in the corporate solution teams, and we work with investors. We really work with a large range of people, and I hope they find our publication interesting.
And with that is a perfect way to end. Thank you very much indeed, and hopefully we'll be learning more about Collier and its publications and all the knowledge that it's imparting to us. Thank you very much indeed. Bruno Berretta, who is Senior Research Analyst, Europe, Middle East and Africa at Colliers. Thank you very much indeed.
Thank you.